Right now, top-tier investment banks like Goldman Sachs and JP Morgan are actively offering their hedge fund clients new ways to bet against the private credit market. To understand why Wall Street insiders are anticipating a crash, we have to look back at the aftermath of 2008. To prevent another crisis, lawmakers passed sweeping regulations like Basel III and the Dodd-Frank Act, requiring traditional banks to hold significantly more capital. In response, those banks effectively abandoned middle-market corporate lending. But corporate demand for cash never went away. Non-bank titans like Blackstone and Apollo stepped in, creating a private credit market that ballooned to $2.1 trillion. For borrowers, they offered faster closures, complete confidentiality, and flexible covenant-light terms traditional banks wouldn't allow. To keep up with massive borrower demand and sustain that explosive trajectory, these firms eventually looked beyond institutional money. They opened their doors to everyday retail investors, funneling an entirely new wave of capital into the system. So the strict regulations designed to fix the 2008 banking crisis did not actually eliminate the system's risk. They simply pushed it out of heavily monitored institutions and shifted it into an unregulated shadow economy. Retail capital is pooled into business development companies, or BDCs, which loan cash to middle-market corporations. This creates an asset-liability mismatch. Investors expect quick withdrawals, but the money is tied up in illiquid, multi-year corporate loans. In early 2026, that exact tension snapped. Investors in a private credit fund managed by Blue Owl hit the panic button, flooding the firm with redemption requests that quickly reached 40% of the fund's outstanding shares. The fund couldn't possibly liquidate its long-term corporate loans fast enough to pay everyone out, so they enforced a strict contractual cap, slamming the door shut and limiting investor withdrawals to just 5% per quarter. The promise that retail investors could easily cash out of their private credit holdings was largely an illusion. The moment broad market panic sets in, that liquidity vanishes. On the corporate side of the equation, the data is equally concerning. In 2025, the official default rate among monitored U.S. private credit borrowers hit a 5-year high of 9.2. This chart compares the official corporate default rate with the hidden, shadow default rate, which tracks companies surviving purely on distressed PIK usage. Between late 2021 and late 2025, that shadow rate climbed from 2.5% to a massive 6.4%. Letting a struggling borrower pay their interest with more debt does not fix a failing business model. It simply takes a visible default and converts it into a quiet, compounding liability. There is another severe conflict of interest buried deep within the corporate governance of these lenders. Many large private equity firms act as the asset managers for life insurance companies, while also being the outright owners of those exact same companies. This dual role allows private equity managers to take an insurance company's float, the everyday premium payments collected from policyholders, and funnel that cash directly into their own high-yield private credit vehicles. To pull this off without triggering immediate alarms from US and EU regulators, they utilize offshore reinsurance. By ceding liabilities to captive reinsurers in jurisdictions like Bermuda, these firms bypass strict capital requirements entirely. Millions of citizens are unknowingly bankrolling high-risk shadow debt simply by paying premiums on their otherwise mundane, perfectly safe life insurance policies. The industry is currently migrating away from asset-light software loans, pivoting sharply to pour billions into massively expensive AI infrastructure and physical data centers. This capital-draining shift is happening right as the macroeconomic environment destabilizes. Goldman Sachs recently raised the probability of a U.S. recession to 30%, citing the impact of looming tariffs and potential energy shocks. Defenders argue private credit remains isolated, but realistically, private funds rely heavily on traditional banks. In a deep recession, a wave of defaults wouldn't stay contained. The resulting stress would travel straight up these financial dependency lines, directly impacting the regulated banking sector. Regulators are finally taking notice. Acknowledging the danger, the Bank of England has officially launched a first-of-its-kind stress test targeting the private markets ecosystem. For 15 years, this massive lending apparatus operated out of sight, accumulating opaque liabilities away from scrutiny. Now, the lights are being forced on. If the global economy is going to withstand the next major macroeconomic shock, we have to aggressively regulate this $2 trillion shadow market before its hidden fractures pull the rest of the financial system down with it.